You can actually write off $100,000 in taxes in just 100 hours. This is one of the favorite tax loopholes for those investing in Airbnbs. This is often called the short-term rental tax loophole. But why is it called a loophole anyways? First, we have to look at what the rules are. When you invest in rental real estate, generally rental tax losses that we create from things like write-offs, depreciation, and cost segregation are considered passive losses. Passive losses means that we can only use it to offset taxes from other passive income. If you want to use these passive losses to offset taxes from your W-2 or business income, either you or your spouse typically have to be a real estate professional. Real estate professional has a couple different roles associated with it, but one of the main ones, and the one that is hardest for most people to meet, is they have to earn more hours in real estate than they do at their job. And so if you're someone working a full-time job at 2,000 hours, it's almost impossible for you to earn more than 2,000 hours in real estate to be a real estate professional. That means if I'm not a real estate professional and I invest in long-term rentals, then my rental losses will sort of be trapped until I can use it in the future to offset taxes from other passive income. But of course, as investors, we want to save taxes today. I want to get my money working for me in the form of tax savings I can reinvest and build and buy more real estate. So this is where that loophole comes in. The reason we call short-term rentals a tax loophole is because when you invest in Airbnbs, you don't actually have to be a real estate professional. You could potentially use the losses to offset your W-2 and other income, even if you have a full-time job or if real estate is just a side hustle for you. Here are a couple different rules to think about. First of all, let's define what is short-term rentals. Short-term rental is any property where the average guest stay during the year is 7 days or less. It could be listed on Airbnb, Vrbo, or you could, be listing it yourself. As long as the rental's average guest stay is 7 days or less, then it's a short-term rental for tax purposes. Now, how do we use this loophole exactly? Even though you don't have to be a real estate professional, you do still have to meet material participation hours. And there's a couple requirements. For that, you only need to meet one of them. The first one is you have to earn at least 500 hours in your short-term rentals. If you have one property, that would be earning it in the property. If you have multiple, you can actually combine your hours in multiple properties to reach that 500-hour requirement. But what if you don't have 500 hours? Here's where the 100-hour loophole comes in. If you buy a rental property that's a short-term rental, as long as you've earned 100 hours in your short-term rental and nobody else has more hours than you, then you can use your short-term rental losses to offset taxes from your W-2 as well as other income too. Let me give you an example of how this works. We have a client named Christina. She bought a short-term rental property in September. She got it under contract, placed it into service, built out all the furnishing, staged it, supplied the property, got it listed on Airbnb with all the best and most amazing pictures, and she had a couple guests that booked and stayed there during the last couple months of the year. Between all the work that Christina did, she had over 100 hours on that short-term rental property. Now the next step is we look at what are all the times that other people have spent on this property. For Christina, because the property was just recently placed into service, there wasn't a lot of other people who worked on the property. In fact, the only people who worked on the property were the landscapers who came in twice, and then also the cleaning crew who came in for a handful of hours when she had guests turnovers. Now for Christina, because she earned more than 100 hours on her short-term rental and nobody else had more time than her, she was able to then use the tax loss from her short-term rental to offset her high W-2 income. In Christina's scenario, she bought her short-term rental for about $600,000. She spent about $100,000 in furnishing and staging and getting all the supplies for her short-term rental. And in that first year alone, between cost segregation and write-offs, she was able to write off close to $200,000 on that property, and in turn save close to $100,000 in taxes. This is a really great strategy, especially for someone who is looking to invest in Airbnb that's closer to the end of the year. When we get to so close to year end, sometimes it's difficult to earn 500 hours. So the 100-hour loophole is especially helpful because there are often not a lot of hours incurred by other people yet who are helping you with your rental property. So as you can see, being able to save massive amounts in taxes investing in rental real estate does not always require that you do real estate full time. You don't always have to be a real estate professional. You don't always have to have 500 hours. This loophole can be utilized with as little as 100 hours, as long as you spend more time than anyone else on this specific short-term rental. If you like this video, be sure to hit the like button and subscribe for more real estate tax strategies.